You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Naufal Sanaullah, Macro Strategist at EIA All Weather Alpha Partners. Naufal, thank you so much for being on the podcast. It is awesome to have you here.
Thank you for having me, and it's a pleasure to speak with you. You seem like a very bright young man.
Thank you. So Naufal, could you tell our audience a little bit about how you got started in the industry? Your journey to where you got to, how you got to where you are today.
Sure. So I started trading at the age of 18. So you got a few years on me in terms of getting in early into the game, but. I was a freshman in college studying mathematics, and I had some money from selling music in high school, and I decided to dabble in the markets. There was a guy down the hall from me in my dorm who had all sorts of colored lines on a screen that he would look at outside of class, and it just seemed kind of interesting. Honestly, one of the things that drew me to it was that the software platforms kind of look similar to like audio engineering and producing. So for some reason, I just gravitated toward it, and it was an interesting time to start trading. It was January 2008, a month after the Great Recession began. In retrospect, and so I initially started with just basic chart pattern type of techniques, learning basic technical analysis type of techniques, predominantly in single name stocks, equities, or ETFs and their options. And this was kind of the time of the big commodities bubble. And, for a long time, the trade was just be long, energy, fertilizers, that type of stuff, and short financials. That March, a couple months later after I started, Bear Stearns collapsed. So I kind of caught the macro bug after that, because it seemed like there were big changes happening in our economy and our society, and we were kind of living through it in real time. And I wanted to kind of investigate what that meant. And so that summer, I decided to do an internship on Capitol Hill for Senator Carl Levin. And that time in DC, as a fresh-faced 18-year-old, was really, really instructive. Getting a chance to just kind of get, from a very superficial sense, get a chance to see kind of how the sausage is made. And what really struck me was how focused so many of these policymakers were on energy prices. And less so about the kind of financial system, which it seemed like they were leaving to some of the academic side of the policymaking communities to, it's too complicated and like leave it to them, it's contained. Whereas the oil price stuff and the dollar falling, that was a lot more like political and politicized. And so, and in the meantime, we were just seeing classic parabolic, like even on a logarithmic y-axis chart, you would just see exponential growth in some of these price charts. And there were a lot of signs that were just based on, again, very cursory understanding of market history that really paralleled what happened in the dot-com bubble, where a bunch of, just very small stocks with very, very small companies that didn't have great prospects were seeing a lot of flows for momentum chasing. And so I remember, late June, early July, we started to see the first trend line in that like oil price kind of, three trend lines finally crack. And that was kind of my signal of, okay, this could now become more of a systemic thing, not necessarily the systemic crisis, but rather that you could see some of the weaknesses and fragilities start to spread into these pockets of fraud. And so the kind of the commodities crash and then the financial crash a couple months later were kind of my first real windfall in my PA. And from there, I was basically hooked. And so after undergrad, I started a graduate program in applied math, and ended up leaving that to launch a fund with a friend of mine who was he was in business school while we were in undergrad. and had spent some time at some prop shops, or prop desks at banks. And we ran that together for about a year and a half, and it ended up not being a great personnel fit. So we ended up parting ways, and I traded my PA from there. I dabbled in a startup while I had kind of the independence and the age to do so. Nothing special really, but it was cool to bootstrap it, get off the ground, and get it to some semblance of having a positive run rate and kind of self-fulfilling and recurring. And then after that, went back to just trading full time. Started the process of looking at different desks at hedge funds and banks and prop shops, and ultimately was approached by my current partner, our CEO, who had just launched a long short hedge fund. And he had kind of a macro orientation toward the way he thought. And so we kind of put each other through the ringer, got to know each other really well. We already knew each other, but we got to know our strategies really well. And that personnel alignment, I think, is really key for running a book with somebody else. It's really difficult to find the right teammates. Really depends on your personality and their personality, even if all of you guys are brilliant. And none of us are brilliant, but we do mesh well. And so, yeah, since then, I've been at EIA as the macro strategist. I'm responsible for macro strategy. Also help out on a macro fund that we have. A macro portfolio within our fund. And then I'm also responsible for portfolio construction and risk management. That's kind of one of the things that we, although our core part of our product is a global long short that my partners manage predominantly, we have a lot of techniques and philosophies borrowed from the levered macro space that informs our risk management and portfolio construction approach, which I think is a little bit different than just looking at net exposures and VARs and this and that. So that's kind of how I got into the markets originally and what I'm doing now.
Got it. Since you have sort of like a mathematical background, now, especially in your early years of trading, did you use any sort of quantitative techniques in order to identify trade opportunities? And even today in your process, is there like a part where you use quantitative techniques in order to identify good ideas and good opportunities?
Yeah, so certainly earlier on, I would try my hand at a lot of systematic techniques and algorithms. Sometimes you would find some cool stuff. To the extent it would at least in my experience, invariably, it would either end up being something that had a lot of alpha decay over time, so it wasn't really that sustainable or durable, or was kind of like it was working because of a more hidden variable that I had not identified at that point in time. So, but we do utilize a lot of quantitative stuff, including at the fund. For example, we have an in-house analytics engine, which kind of is, like our in-house analyst. It's both kind of like, it's a screening and filtering tool, but also does provide a really solid kind of glimpse of the fundamentals and the way we kind of want to rank, order, where we want to put our focus in terms of looking at individual companies. And those parameters are they're contextual to different industries each. So, you have different KPIs that matter for different industries and within different macro backdrops. So that really helps us, stay focused on the actual qualitative and subjective elements, because we're kind of following the same approach. It's not rocket science. And, if we could build it, then, anybody who just goes on Coursera and learns Python for a while can. The actual quantitative techniques are not that, sophisticated. I don't think that that's necessarily going to be a place that we can have a durable edge or value at. Also, we utilize a lot of quantitative and relatively systematic approach to our portfolio construction, like I said. But again, that's more about how we have structured parameters and how they're time varying over time, as opposed to really finding some hidden secret sauce. We're not one of those funds that we find 20 different arbitrage type of returns and then continue to iterate and find more and more and more over time. We're certainly those just are kind of our guideposts, and from there it's kind of cool because I forget who said it. I don't know if it was like Picasso or something, or Einstein, or maybe I don't even know. But basically, the notion, I'm paraphrasing here. The notion's like, if you give me a piece of paper that's completely blank, that can really unlock a lot of creativity because I am, forced. Or I'm sorry, if you're given a piece of paper and it's blank, it's like, what do I do with it? But if you really box yourself in, like only use one color, one shape, this or that, then necessity is the mother of invention, and you can innovate, be creative. And so that's kind of how we approach our portfolio construction. Is we very well define and box ourselves in, and that allows us to kind of it liberates us to really focus on what are the crazy asymmetries we see, and we don't really have to. We're okay with taking different ideas we may not otherwise execute upon, and then the market tells us whether it's worth investigating.
Yeah, got it. I wanted to talk a little bit about sort of your macro outlook and your thoughts on markets, as we speak. So, what is sort of your macro outlook for, say, the next 8, 12, 24 months, especially, with a focus on inflation versus on the inflation versus deflation dynamic, and the dollar and commodities.
Right. So, first of all, I would say the broader macro backdrop remains very interesting and supportive. Obviously, we've had a lot of fiscal stimulus come through the pipeline, and that's led to a lot of excess savings or elevated personal savings. And as we reopen, we probably see a lot of that get deployed into the real economy. So a bit of a handoff. There is an extent to which these savings are, the distribution of them, the skew, is a little bit important because, a lot of wealthy people have a lot of savings right now. And, they're not necessarily going to be spending all of it all at once. They don't have super high marginal propensities to consume. But there has been a big kind of safety net and floor put in a lot of things that on the lower end of the spectrum that were not there before. For example, the child tax credit is like one of the most interesting and likely to be effective fiscal policies of my lifetime. And, back to school shopping season should be bonkers. Same thing applies to kind of, we saw a lot of layoffs because of COVID. And now we're in an environment where there's been a lot of fiscal support for those same folks who are unemployed. And as companies want to hire back, they're hiring back at much higher wage levels than they were, laying them off a year ago. That's a really interesting dynamic. That's very stimulative. And lastly, my friend John Turek, he has this great chart we always talk about where, you just look at, EPS year over year, a year later, that line looks the same as CapEx growth. And, corporate CapEx responds to demand. And, if you look through like the Kolesky-Levy profit equation, which is an identity developed by both Kolesky and Levy, which I would consider them kind of post-Keynesian economists, which is kind of the worldview I tend to share. That CapEx, one company's CapEx is another company's profits. So on an aggregate top-down macroeconomic basis, those three things add up to very, very supportive environment. To the extent we had supply constraints that kind of constrain growth this year, it pushes it out a bit just to next year. So I wouldn't be surprised if, we got to close to or at another double-digit nominal growth environment next year, which I don't think is necessarily discounted. I think that there's still this, people are still kind of psychologically benchmarking to the last cycle's pace of recovery, and a lot of things can kind of derail what we're talking about right now, especially politics. Whether it's like Le Pen winning or whether it's Democrats having a poor showing in 2022 midterms, but that's also down the line anyway. But more generally, the outlook remains very favorable on a growth perspective, in my view. In terms of inflation, I don't have anything super novel to say about it because we saw the big supply shocks in like lumber and stuff, and that's kind of the market did its job. It reversed. The Fed had been kind of running this very pro-cyclical monetary policy in terms of its messaging, which was, first it chops off the left tail, but now it's opening up the right tail of distribution. And then, last week, the last FOMC, they decided that the right tail was getting a little uncomfortable for them because of inflation risk, and probably had a lot of pressure from folks like Larry Summers in terms of like especially the regional banks presidents. So that started to change some of the inflation pricing in other parts of the market. And so I'm not super concerned about inflation in the context of, I think that a lot of the stuff that was temporarily elevating it is going to roll off. I would add two things though. One, rents are likely to be pretty strong and supported, and that is likely to provide a pretty strong offset to the kind of transitory stuff rolling off. And you know, if you're seeing rising rent, you know, OERs at the same time as rising wage growth, or at least high wage growth, I could see a scenario where, you know, we're not seeing inflation feed on itself, but it could be a little bit more volatile, maybe a little bit higher on average this cycle, which makes sense within the context of an average and flexible average inflation targeting framework. And then finally, what I would say is, you know, the things that, you know, last cycle we all kind of the market finally like just accepted, acknowledged, is, you know, the big disinflationary factors being structural, you know, demographics, globalization, technology, financialization, and just the bargaining power between labor and capital, the political backdrop that we had. You know, I really do believe inflation is fundamentally like a political phenomenon. And so those we are in a different environment along all those vectors now, except for potentially globalization. Global, I mean, and even that, you know, we could see, even if we are not deglobalizing, we could have seen kind of peak globalization impulses as we start to see, you know, an American industrial policy and maybe some more, you know, hawkish rhetoric between the Americans and the Chinese. And but anyway, the idea here is millennials are now in their sweet spot of household formation, which is very different demographic backdrop than before. You know, financialization, we're still quite financialized. There's still a lot of debt in the economy. And so that still plays a role, but I wouldn't be surprised, for example, to see private leverage fall just because of the extent of nominal growth we're likely to get over the next 12 to 18 months. And then lastly, technology. Technology certainly continues to be playing a key role. So I don't necessarily think that, you know, we're going to have major supply constraints in the long run. We could see pockets of them rolling, but most importantly, I think it's just that we have a different political backdrop and a different demographic backdrop, at least for the next few years. And so the ramifications of that could be a little less disinflationary of a backdrop than we had last cycle.
Got it. You know, so with this sort of backdrop in mind, you know, talking about peak globalization and, you know, sort of an American industrial plan and so on, what would be, you know, how would you go about constructing a portfolio for, say, the next decade? What would you be, you know, long? What would you be short?
Yeah, so a lot of these themes we ultimately are going to be expressing in our long short book. And a lot of that individual security selection is going to be within the realm of my partners. You know, I'm happy to read a central bank's balance sheet, but a company's balance sheet, I'm probably no better than anybody else at it, you know. And so, yeah, you know, we'll find, so, you know, like we'll pick themes and we'll find kind of what are the most asymmetric opportunities within those spaces on a single name basis. Kind of the rule of thumb we have is if we can't express this through a futures trade or an ETF trade just as well as building our own basket, then let's not build a basket. But if our basket really seems superior to just a futures trade or a liquid ETF trade, then we feel like we have an edge on the single name side of individual single name selection. And that's kind of how we approach that part. So a lot of what I'm doing is, a lot of time I spend doing is just making sure that our broader portfolio is relatively balanced across different risk vectors, whether it's time horizons, whether it's factors, whether it's mean reversion versus momentum, you know, like styles, whether it's sensitivity to different macroeconomic environments, you know, higher, lower growth, inflation, dollar, commodities, yields, all those things. You know, we have multiple what I call vector spaces, and then lots of different vectors within them. And like, as long as we're not hitting any yellow lights in terms of excess, you know, capital at risk within those buckets, So that's what I spend a lot of my time doing, is making sure we're balanced. The sizing part, do we need this trade if we have that trade already? This trade's really gone up a lot. Either tighten up the stop a little bit, or we have to take some off the table. That type of stuff. But in terms of the pure macro portfolio, that is, the goal there is anywhere from like 6 to 20 uncorrelated return streams that I find independently compelling. And sometimes I'll have a hedge portfolio within the macro portfolio for the long short. So hedging some excess or deficit positioning or exposure in the long short book. If I'm able to identify a very independently attractive and asymmetric exposure that can balance our long short that I like on my own, and I'm not forcing it, that can also make its way into the macro portfolio. So that's just the background for how I think about constructing specifically for our fund. In terms of how I would kind of put those views into action, a lot of what I spend my time doing, as you know, is trying to marry macro narratives with charts. And the way I look at price action is it's kind of like a footprint, a digital footprint of our psychology in the market and the narratives and the stories that we tell. It really is about the stories in my mind. So, where are the levels where there's been a lot of volume transacted? Where have there been gaps? How do I define different regimes and ranges? And so, for example, right now, one thing we've been writing for the last month or so has been short euro versus Mexican peso. The notion there is that it's summertime. The markets seem to be kind of in a grind. The VIX curve is very steep right now. So even if we have little bouts of volatility, exogenous shocks, whatever, there's a lot of buffer for the next couple months. Before the curve starts to invert and there's like forced selling, and realized volatility is relatively low. The Fed shock didn't seem to derail broader risk assets, and if anything, kind of quelled some fears, of inflation. So in that type of backdrop, if I'm expecting a lot higher growth than people expect, then shorting Euro Mex is a great summertime carry trade for low vol that is exposed to American growth, right? Because a lot of this growth is going to leak abroad, and Mexico and Canada are huge trading partners. Mexican growth is very sensitive to American, and interestingly, very different EM central bank backdrop versus last cycle. By which I mean, the Brazilian central bank, the Mexican central bank, they've been hiking. In fact, the Banxico just hiked last week. So they have a different sensitivity to Fed hawkishness than before, and I think that it's just an interesting setup. And so then you look at the charts, and it's like, okay, first Euro Max surges during COVID, of course, because of risk premium blowout, and then there's a little bit of a normalization trade, and then it's been in this very wide range. So the floor of that range has been 2350-ish. If that can crack, if we see follow through in this trade, after now that we've gotten that hike last week, and 2350-ish cracks, and we exit that range, that would kind of confirm it to me on a technical basis. And so the macro, the narrative, and the charts are aligned in terms of the trade, and the backdrop is supportive for it to work. So that's an example of how I would turn that broader backdrop idea into an actionable trade. And my favorite part about it, and my favorite part about any trade I like, is that if it's cheap to be wrong. If we reverse the move since the hike from the Central Bank of Mexico, if we reverse that move, then I'm out. At least I'm going to wait. I'm not going to just hold on. But if it does what it's supposed to in this trade, which would be to break down out of that range, then I can keep trailing my stop a little bit. And there's a lot more downside in that cross, a lot more upside in the profit curve of that trade than I would say is risk. There is risk. So yeah, that I hope that gives like a sense, and I'll try to think of more.
Yeah, that was awesome. Could you also talk a little bit about how you think about expected value for these macro trades? So, for example, you talked about your short euro long Mexican peso. How do you actually go about thinking about expected value, especially for macro markets, is like currencies? It's harder to arrive at a fair value than say fundamental long short equity investment, because you can sit down and run a DCF model or something. So how do you actually go thinking about expected value when it comes to this macro trades?
Yeah. So in terms of, I would say that probably one of the toughest things to do in this game is riding winners. Like anybody who just like held Apple and Amazon for decades or whatever, they've minted a fortune. But how difficult must it have been, right? There's a couple ways to approach it. One is I focus a lot on sizing. I have kind of like 5 different like layers of sizing, you could say. And so, if I really believe in a trade for like the long term, like structural trade, I can at least keep a stub position, a small position, because the smaller position you have, the more volatility you can kind of ride through. And so, and then kind of add and subtract around it, which sometimes is very valuable, sometimes definitely detracts from the profits you make, but usually applying a more stringent risk management to the additional layers of sizing, it does help to chop off some of the serious volatility and tail risk. Although, like I said, it's not a free lunch. Honestly, like in Euromex trade, a lot of the targets, and again, I try to avoid having too religious of targets. I basically just try to eyeball a target just to have a basic idea of risk reward. If I'm looking at like something like a Eurodollar futures, like if I'm trading like fixed income forwards in the U.S., there's a little bit more of a quantitatively destination based derived target. Like at some point, LIBOR is going to be at X level by Y date. So you can benchmark things a little bit easier that way. It's less of a, just look at the charts. It's also kind of like, this is what I believe LIBOR will be September 2023, or SOFR will be in December 2024. And then you can do your risk rewards from that. But so for the Euromex trade, for example, like there's a couple things I have in the back of my mind, and they both seem very crazy, even to me, to even say this. But I have to kind of keep it in mind. One is if you just look at a chart of the emerging markets MSCI index, like a weekly for the last 20, 30 years or something. It spent a lot of time, spent like what, a decade and a half now or so, just in a very wide, long range cross cycles after having, huge move during like the Bush administration. It's just been in a wide range since. This year seems to be finally breaking out of that. And it kind of makes sense to me that in a world where both the US and China are growing so fast, and we're not just seeing constant rolling shocks, whether it's European debt crisis, whether it's commodities crash, whether it's China depreciation of its FX policy, whether it's dollar shock, it's just a very different backdrop. And EM is like, it might be in a new regime. And then I look at kind of what the pre-COVID Euromex, range was, and like maybe we can go to 20, maybe we can just grind our way to 20, with certainly pockets of upward volatile shocks along the way. The way I would approach it is, one step. I trade it one step at a time, especially for the additional layers of sizing. But I kind of keep that idea in the back of my mind, even if I'm getting back into a trade or getting out of a trade, in that, am I seeing signs that magnet is being validated by the market, by the broader economy, by the story, by the narrative? And if that's the case, I'll kind of keep that in the back of my mind. And if it's not, then, I just move on to the next one. Similarly, like I look at, the NASDAQ, that's been something that we've liked a lot since April or so. April, May, because, we are, we had a lot of right tail of the growth distribution open up in Q1, as we saw the Georgia runoff elections, as we saw the implementation of flexible average inflation targeting, and as we saw the vaccine rollout be so successful and beating expectations. And speaking of which, we kind of played that same trade in Europe starting in Q2. And now I think, emerging markets are set up well because there's a lot of excess supply now within the developed markets in terms of vaccine supply. And so there's going to be a lot of alleviation of supply constraints for the vaccine rollouts in these emerging markets. But anyway, the NASDAQ, the FANG stocks have kind of just done nothing. And they're still crazy growth. They grow very fast. The extent to which they have kind of political obstacles, I don't think is going to be structurally derailing them. In fact, I wouldn't be surprised if, there's some optical stuff that goes on in terms of, trying to stifle. But on the offsetting that would be American industrial policy may just run through the FANGs. They may kind of end up being quasi-national champions and being even more interconnected with our state apparatus, whether it's DOD, whatever. And so, yeah, I think that the FANGs are really interesting. If we're in this environment where, we're going to grow fast, the right tail's been chopped off a little bit because of the Fed. That's the narrative right now. Why don't US and China large cap tech? Why is that not the perfect environment for them? Interestingly, both of them have had their sensitivity to interest rates has come down a lot, and so they can deal with higher rates in a much better way than, for example, November and January. So the initial conditions are very different, and so your max FANGs with the FANGs, the way I kind of look at it is pick a forward PE where they seem like rich, and just kind of backwardly do the math, pick a 1 or 2 year target. It's a lot higher than where the risk you're pick a stop, and it'll just be asymmetric in my opinion. So that's like the general framework.
Right. No, yeah. So one thing that you mentioned was sort of the EM chart and how EMs finally seem to be breaking out from sort of their multi-year range. So number one, how do you think about technicals versus fundamentals for non-crypto assets, and how do you figure out what fundamentals actually matter for a market?
Yeah, that's a great question. There's some cool stuff that a lot of people I read who do a lot of machine learning to try to identify what are the variables at play at any given time. And I don't kind of utilize them as an input, but what I do like to do is read those and then see how well they're, if that's a general quantitative assessment of what's the important factor here and now or in the recent past, I'll take that, for granted, kind of like how, I remember listening to your podcast with Jim Leitner, and he was just kind of saying, a stock's fair value, I'll just average the sell side estimates. Yep. And that's okay, that's the street, right? So same way, I'll kind of just take a look at some of these outputs that folks have, and I won't use them as inputs, but all right, that's like the general quantitative assessment. And then we have our own models as well. So we'll look at that. And then I try to see what's the story, what's the narrative, and then how are those two things intersecting in a way that that we see the digital footprint of that intersection in the market's price action. And so, fundamentals versus technicals. I mean, technicals really matter to me a lot, especially because they help me define my risk. Again, and if I'm trading like Eurodollar futures, a lot of that is more about kind of distribution, implied probabilities, and my risk can be a lot more fundamentally oriented. If something that I think is likely, if I think X can be a 50-50 odds to happen by Y date, and in my opinion, the market's pricing it at 10%, I'll just risk it going to 0 to play for it to go to 50-50. And maybe I'll cut it at 5%. Maybe I'll just say, all right, if it's going below 5, then maybe I'm missing something. Maybe I'll wait till it gets to 5%, and often that means I'll miss trades. But that's a little bit more fundamentally oriented risk management. Then the correlation element definitely adds a lot of complexity and this and that. But in terms of like the technically oriented stuff, yeah, like I'll just look at charts and try to marry them with narratives, given my macro assessment in the background. And it really is kind of like it's the macro, narratives, and price action. And then all three of those things intersect with each other in both directions. So by which I mean, if I have a macro assessment and I see a narrative in the market and the price action is confirming it, and I'm in the trade because that's the trade that's working, and that's asymmetric, and it doesn't seem to be really matching my macro backdrop. And then I see more trades emerging that again continue to not really match my macro backdrop. That tells me where to look to reassess my macro framework. And so it works in all those directions. It's not really about one or the other. It's more about how they fit together, and how, especially if I'm able to fit them together in a very simple, like non-complicated, not complex way. The fewer assumptions and fewer steps I have to take, the better I like to trade. When we saw the Georgia runoffs, like I had a view that they would go well for the Democrats. So, it's a rates trade. And then when it hits, it's like, okay, like this can reprice for a while, or, at least maybe not in time, but in terms of price. And then from there, I'll just let the technicals take me out of the trade. And so, yeah, that's a very simple trade, but sometimes simple is best. In terms of crypto, I think it's like the perfect technical asset because it's such a high inequality asset because so few people own such a big chunk of it, and there's like no turnover among those folks. And so the rest of it is just basically speculation. There is like there's been an institutional tailwind flow, or rather flow tailwind. It's debatable the extent to which it persists at the same pace, but yeah, like it just seems like very amenable to technical analysis, basic chart patterns in a way I haven't seen in any asset class. So I have like my story, my narrative, and then my kind of macro view of crypto, but I just trade it off of technicals. And because it's so volatile, and because we've tried not to take weekend risk, because we do trade the futures, these are small size positions, but a lot of asymmetry in the last 2 years has arisen from our crypto trading, and that's a purely technical strategy.
Right. How do you actually go about generating these ideas? So, for example, you spoke of the Georgia runoff versus Eurodollar. Does it just come from reading the news, or what is that?
Yeah, it is like, yeah, keeping a pulse on the news, keeping a pulse on the narratives, like talking to a lot of folks. This is definitely like a cumulative game where, like, over time you kind of pick up a pulse on what's important, and then you're just trying to get ahead of the next shift. Unlike somebody like Jim Leitner, who and we use like his approach of kind of, I'll have the super convex options trade for this big picture view, and I'll just set it and forget it. Like I can sleep at night, and I'll roll the trade, and like I'm not necessarily stopping out unless I change my mind. That's part of we kind of run that strategy as well, within both our macro and long short stuff. But for someone like me, my personality, what I'm spending more time doing is more of like a little bit more active and lower hit rate, and getting out a lot of stuff, higher turnover. In that type of stuff, it's kind of more to me like like playing basketball, where like it could be more streaky. And so the way it works is, you get a pulse on the market, you get a pulse on, okay, like we were lucky to get ahead of the COVID crash, and so that allowed us to keep the momentum and be a little bit ahead on what these big fiscal monetary policy shifts meant. And I spent the last decade trying to like imagine what this type of stuff would mean before COVID, as we would learn more and more about the real economy constraints that were, all the myth busting that was going on in macroeconomics at the time. And so we finally get it. And so then it's like, okay, like, is this the big political shift too? And And so we saw, then for example, when Trump, former President Trump, was like, no, we want the big checks. He went against the Republican Party and said, no, I want the full checks sent out. That seemed to be like a easy thing for the Georgia Democrats to campaign on, because it boxed in their Republican counterparts, and until the very end, where the Republican candidates ended up kind of pivoting away from the party's platform last minute to try to save this election.
Yep.
And so that was just that. And then talking to a couple of buddies who were relatively plugged in politically about like, what is your what's your assumption here? And then is it asymmetric to play it? If it didn't happen, I'd be out, but I might have gotten back in, because then we had the vaccine rollout beat expectations. So like all those things kind of combine, and the way it works is like, you want to keep a pulse on the market, you want to keep a pulse on the narrative, you want to keep a pulse on the backdrop, and have a decent idea of what the price action is signifying. And then as long as you have that pulse, you want to ride it. And then once you lose that pulse, once you feel like you're no longer a step ahead, but maybe right where the market is, maybe a step behind, then it's just you're Sisyphus, rolling a boulder up a hill until you get that pulse again. And a lot of that is about what's your personality like, and how do you build a portfolio construction and investment framework that is optimized for your personality, and how well do you recognize your own strengths and weaknesses, and how well does your investment process adapt to them. Again, absolutely. that's a lot more important for active traders, especially of levered products, people who are chasing narratives and stuff. It's if you're a different personality and you have a different strategy, you're a lot more passive, you're a lot longer term, you're a lot more destination oriented instead of path oriented, then you don't want to do that, right? So it really depends, like in terms of like what's occupying your mind share in order to generate these ideas. It really depends on your personality, your strategy, your temperament, and what works for you. What works for me is just like first thing I do every day is I wake up and look at different interest rate forward curves around the world. Just get an idea of like what if rates are like kind of the basis of like equities, currencies, a lot of stuff. What's going on there, and is anything like sticking out to me? Keeping a pulse on politics. I think having a diverse set of friends and fellow traders and portfolio managers I talk to really helps a lot. My partners, because they're equity oriented, single name oriented, they're always picking up on like new developments in different industries and technologies, which I may not otherwise be exposed to. And so that, that always kind of, you just come across ideas, or something kind of sparks something in your mind. And if you could find a cool expression of the trade, there you go. A lot of times the best thing to do is not trade. And that's something that, it's a difficult instinct to fight, is, the need to trade, right? And so, and a lot of that, that's really important about understanding if you're on a good streak or not. But yeah, it really is all those things. One thing I've recently found to be valuable for me, in terms of like something more discrete for me to explain or describe to you, would be, I've kind of been, I was in a lot of really big group chats, and I still am, whether it's Bloomberg, whether it's on Twitter, whether it's on different Slack channels and stuff. And it just kind of ends up being like, first of all, I'm not going to read all these sell-side reports, and secondly, like, it just like, I'm not going to try to trade like, something deep in the weeds of money markets, or I'm not going to like trade like, a Chilean election or something, because I don't know anything about that stuff. And even if I did, I don't know if it'd be like up my alley. I try to stay with liquid stuff. But one thing I've been doing recently is just having more groups with fewer people. But those people, like, a lot of times you'll have like, like your 5 like favorite folks, and you have like a Bloomberg chat or DM chat with. What I've been trying to do is join more groups that are small but very different people who may not actually be people where you can expect we're going to be having lively debates. And that's been one thing that I've noticed has been, it just kind of like accelerates the learning curve for some stuff for me, because I'm just getting exposed to like more stuff in a deeper way. It's not getting lost in the noise. We're actually having back and forth dialogue, and so more stuff gets pointed out to me. And I love running with other people's ideas. I love it. My partners, they've really liked copper for a while, coming out of COVID, just because you need 3 times as much copper in an electric vehicle than an ICE vehicle. 40% of the supply is in 2 countries that currently in Latin America that currently have a little bit of political uncertainty, and it's just a different there's no shale fracking type of producers that just turn on and prices rise. So they've really liked that trade, and at first I was like, I like the trade. I don't know about these crazy targets you're talking about, but over time, it's cool to it's a back and forth. I'm learning something about my own, I'm supposed to be the macro guy, and I'm learning something about macro from what they're reading in terms of the earnings transcripts and conference calls with these big producers, and it becomes a big picture theme. And so then then you kind of drill down and trade it level by level, and keep the risk kind of managed. But so yeah, that's a very long-winded way of saying, in terms of where the idea generation is very, very diverse, and it's just a cumulative process, and once in a while you kind of have a pulse and you run with it.
Got it. Thanks for that. It was really detailed, very helpful. And I also wanted to touch up on China. So, what is next for Chinese equities and Chinese credit? How does that influence commodity demand from China? And adding one more part to that already super broad question, where do you stand on the renminbi, especially in light of the new development of this digital yuan?
Yeah, those are great questions. Let me confess. So I'm not somebody who knows all the individual China tickers. I don't follow the space of the Chinese corporate sector on a deep basis like a lot of other people might. So this is just very top-down type of views. And sometimes, especially Chinese equities, liquidity can matter more than anything else. More than macro, oftentimes more than earnings. So that's something that's my caveat. But what I would say is, I like the big China tech names. I think that there's been good reason. We've seen some derating because of the risk of what's been going on in terms of this antitrust, anti-monopoly type of stuff from the CCP, which is interesting because you can contrast that with the approach the U.S. is taking, where it's still a lot more freewheeling, kind of do whatever you want, although there's that could be changing a little bit on the margin. But in spite of that, I think this is the right macro backdrop for the growth that these companies put out to be, for people to reassess how much they should be worth and how much a premium that you should pay on them. So I think I do like the Chinese equities. In the past, especially last cycle, you could trade a lot of the stuff, whether it's Chinese equities, whether it's commodities, EM more broadly, even S&P ex FANGs, just by looking at the China credit impulse, because the U.S. had kind of a relatively slow, durable but slow recovery. Europe was just a mess, and China was a big engine in both directions, just with its credit, with its credit creation. This cycle, it seems a little bit different because the U.S. is growing so fast. And it's such a different distribution of growth. The China credit impulse hasn't been it peaked, and last cycle we would have had the correction and a lot of stuff, but the markets have kind of digested it pretty well. In fact, even the macro economy has Chinese PMIs. The latest Chinese PMIs were actually pretty strong. Sales are doing fine. So I don't think that those kind of big things to be afraid of are less important this time around, as long as the U.S. keeps this monster growth engine and political backdrop. I would say through middle end of next year, I think that's still going to be the backdrop. I don't see that changing. And so I'm a little bit less concerned about Chinese equities because of that. I don't, besides kind of the tech stuff that I follow, and besides that, I wouldn't want to make too much of a assessment about the Chinese equities market or credit markets. I just don't know enough. I don't follow that stuff very closely. But in terms of commodities, like, yeah, it's interesting to me. Like I said, like China seemed to, they started really, we're done stockpiling. We're a little bit uncomfortable with like the pace of commodities inflation for good reason. Maybe they kind of put a ceiling on things in the short term, but I don't see that being overwhelmed. Like, I think that the broader macro backdrop will overwhelm that, both in terms of the decarbonization of the economy is pretty commodity intensive, and the supply and production capabilities are not necessarily there at these prices. So, I do think that there's likely to be scope for, the commodity demand and supply story in certain commodities to be there still, even in oil, right? Like, because we are decarbonizing, the fracking guys aren't expanding rigs even at these prices. Not even the super majors are. It's really just private producers. So you need higher prices to, like, I could see OPEC kind of. I think that OPEC could kind of create a short-term ceiling soon, because they want to keep that backdrop of, the shale producers in America have found capital structure religion, and we don't want them to be, chasing prices higher with their rigs. We want to maintain market share. So I could see them kind of placing a ceiling in the short term, but the broader backdrop, I think, would remain supportive. And then with respect to the renminbi and DCEP, which is the digital currency, I think it's a really interesting story. I think it'll become an increasing part of the narrative and mind share in the run up to the February Winter Olympics in Beijing, which I think is going to be kind of the big coming out party from a PR perspective of the digital currency. So there's a couple different cross wins to think about. One is, unlike last cycle, the Chinese this time around are kind of like the only yield in town. I mean, the US is starting to be kind of in between, Europe, Japan, and China, but China never really dramatically eased and has been much more orthodox in how they're dealing with the recovery. They have a very different policy stance than America does. And so there is like a yield premium, although, that wanes and waxes given what the Fed's doing. This is coming at the same time as the Chinese government bond market has been never more than now has ever been this accessible to foreign institutional investors. You think about like risk parity, you think about 60-40, you think about volatility targeting type of approaches, any strategy where you're kind of using the covariance of risk assets and government bonds to allow for different allocation sizing, leverage, and uncorrelated return streams. That idea, there's still, if yields go to zero, bonds are going to go up a lot in price. Don't get me wrong, but there's a lot more fear now about, like, am I getting the same hedge value in my treasury bonds? Chinese government bonds, on the other hand, they have that yield spread. They have opened it up the market a little bit, and they could kind of have a relatively one-way suck of capital, which would support the renminbi. Again, with waxes and wanes, but different than I would say last cycle. I think we could be in a structural renminbi bull market with a lot of volatility in between. Also, the digital currency aspect, I think, is interesting because I don't expect, for example, the renminbi to overtake the dollar in terms of reserve currency share, but I could see it whittle away at the invoicing share, the transactional share, both domestically and cross-border, even the reserve asset share, which are all kind of different things. Sometimes we kind of group them all up into one thing, but they're all different weights and shares and market shares and competitions. I could see a scenario where DCEP allows for a lot of reduced frictions for some strategic exporters to China that allow it to bypass the dollar/bank channel, private bank channel. I could see it being utilized commercially. For example, we saw a lot of Chinese apps being downloaded by Europeans and Americans during COVID. Perhaps perhaps it becomes native to use their digital token. What that means to the currency, I don't know. But like that's a narrative I want to test. That was a hypothesis I want to see tested, and it's interesting to me. I wouldn't want to speculate too much about what it means, but it's more about let's see what happens, and let's keep that in the back of our minds. It doesn't need to be a debate about is China going to overtake the U.S. dollar. It's more about like on the margin, are we going to see increased utilization of the renminbi because of its digital component now? And then what does that mean for the Fed? What I call like Fed coin. There's a lot of really cool proposals by people like Rohan Gray, people like Robert Hockett, who used to be at the New York Fed and actually teaches a class with Paul McCulley. So he's very well versed in monetary economics. They're kind of frameworks for the digitization of the dollar, the idea of having people central banking, the idea of having tokenized wallets for the people. What does that mean? How do the different power structures deal with that? What does Wall Street think about that? For example. But yeah, those things are questions more than answers. But yeah, I do think that there's likely to be kind of a structural tailwind this cycle for the renminbi vis-a-vis the dollar, especially if the Fed is serious about this flexible average inflation targeting. It's a lot different of a policy stance and policy cocktail in America versus China than it was last cycle.
Yeah, and I wanted to go back to sort of the topic of portfolio construction, and so how do you actually go thinking about exits, as it relates to sort of time exits? So you've got a trade on, you've got the story behind the trade, but then sort of the trade isn't playing out, but the story hasn't changed. So how long do you stay in such? Do you have sort of like a time stop? So if there's like 3 months when the if I place a trade and then 3 months after it still doesn't work, just want to get out. How do you think about it? Yeah.
That's a great question. It really is, unlike a lot of the stuff, it really depends. One thing I like to try to do is I try not to keep my head or my mind too kind of littered with different stuff and distracted. I want to maintain the level of focus. I want to be able to the stuff like meditation helps as well for that type of stuff. But I want to be able to have disciplined focus of my energy and where my mind share is at any given point in time. Part of that means, if I put on a trade, I like the trade. I think the story is there. I don't know when it'll work. I'll just throw on a stop and just kind of forget about it. If it's not moving, I'll let the stop take me out. I'm not going to overthink it, especially because the real work for that trade is all the preparation before it. Especially does it check all the portfolio construction and risk management boxes. Once I'm past that point, I'm not that concerned. It's either cheap to be wrong or it's working, and that's all I care about from there. I'll keep an eye on the story, but I'm not going to try to be too cute with it and overtrade. However, for example, if I see a potential inflection in a narrative emerging, if I'm trying to get ahead of a narrative shift, especially if I'm trying to get ahead of a technical breakout or breakdown, then I want a time stop because I want it to work immediately. I want it to work very soon. And if it's not working very soon, I'm just going to wait for it to actually crack or be validated instead of, kind of stay in the trade and now I'm stopping out at a worse point. And, I was already trying to jump the gun anyway. So especially stuff where I'm trying to get ahead of the market, both in terms of narratives, both in terms of technicals, I'll have a time stop. For example, when I was, I kind of had a bit of a different view than a lot of folks toward the end of Q1 about the European vaccine rollout. There was a lot of negativity for good reason because they botched it, right? They first, it was very bureaucratic in terms of how they secured the production supply because they went through Brussels, the European Commission, for the entirety of the continent. And then they were very price sensitive, and they were very cautious about, do we go straight to administering doses? The US and the UK, they were very price insensitive, and they just started jabbing people's arms. And that ended up being the wiser calculus. And they also had a huge issue with the AstraZeneca rollout, and they lost a lot of public trust because you would see there were some signs of side effects, although they were dramatically overblown. In terms of risk reward, it was just overall very botched, and it had political consequences. And so people were just kind of like, yeah, like this American exceptionalism trait has a long way to go. Whereas I had the view that Europe will really surprise in Q2 with its vaccine rollout, because one, there is going to be a political effect of this. Macron is not going to want to lose to Le Pen, and there's going to be a little bit of a more cavalier attitude to getting jabs in arms, especially after seeing the success the U.S. and the U.K. and Israel had. And then at the same time, in terms of the French in particular were characterized as being very anti-vaxxer for good reason. But they weren't always this way. In fact, the French population used to be among the highest in the world in terms of trust in vaccines. Different things occurred in the 80s, 90s, and aughts that changed that. And so I looked at this as potential inflection. If you're on, we're all connected on social media. If the Europeans are looking at Americans going out to bars and stuff again, and like being vaccinated and normalizing, they're stuck in lockdown. That FOMO, I thought would help. So you have the supply side in a much better place, and you might even have the demand side in a better place. And then you look at the kind of underlying narrative, and it's just like the complete opposite. People are very pessimistic, and so in that type of scenario, like I am getting ahead of the market. I'm trying to anticipate a narrative shift before it occurs and before the breakouts occur in the charts. So I put in a little bit, and then if it starts to be validated by incoming news flow, incoming narratives, incoming research, and incoming price action, then I'll add to it. I'll martingale, and if it didn't work, if it didn't work within like a couple weeks, I would have gotten out and just waited, maybe tried again. But like I wouldn't have wanted to allocate my mind share to having to track this. So I hope that kind of gives some context.
It does, and thank you for that. To wrap up the podcast, it is sad that the podcast has to come to an end. I could sit down and talk to you for hours, but what are some sort of your favorite books and resources that have actually helped you, with trading, and more specifically with macro strategy?
Books and resources? Yeah, that's a good question. Like I'm sure that a lot of the books that you post on like some of the threads you do, and some of the guests that you've mentioned, that's going to cover a lot of stuff. Like especially for younger folks. Like I started by reading Market Wizards and stuff. I think one thing that's interesting is reading. Like Stephanie Kelton is a friend of mine. Reading those white papers about how like the monetary mechanics of the U.S. work was really, really valuable. I would say even like alpha generating for a while. So like getting a good idea about what is the frontier. Like I spent a lot of time reading white papers. My math chops are not like these young kids these days at all. But so it takes me a while to follow along some of these, like what's new, what's cool, in the preprints and in some of the journals. But I'll try to keep an eye on it, just to have an idea of what's the ecosystem like, and what are people thinking about, and how is that going to be changing the environment I have to trade in. And the same thing applies to the economic space. A lot of it comes from just talking to other people. But what I guess one book I liked a lot was the writings of Nicholas Kaldor. I forget the name of the book, but it's actually, I think I have it right here. Yeah. Causes of Growth and Stagnation in the World Economy. Highly recommend this book if you have like a little bit of a background in macroeconomics and are able to kind of read the diction. my friend Matt Bozel recommended it to me. It's really interesting, because it's such a different approach. It's not like going to give you a different like formula to like here you go, but it reorients how you would otherwise think about these debates. And a lot of times the best trades don't come from getting like you get these big debates like you were talking about, like inflation or transitory versus this or that. A lot of times the trade isn't necessarily getting the debate right. It's more about approaching it from a different perspective and kind of understanding the conditions in which either side can kind of control the narrative, and then identifying the conditions and kind of going from there. Like of course, like the thinking fast and slow Kahneman stuff is great. That's always great, I think too. There's a lot of books on like one thing I recommend people to do, especially younger folks, is read like the Asian press, like South China Morning Post and like the Nikkei and just like stuff out of South Korea, stuff out of China, stuff out of Japan. Just keeping a pulse on like how are they thinking about the world and how is it different than how we're thinking about the world. Wall Street Journal's not going to capture all. And once you kind of get an idea of the different kind of players and factors, especially in China, reading books on the Chinese economy, you can read it from a much more pragmatic and objective lens, because you're not really coming at it with just the typical univariate Western perspective, which, and that works, for anybody, obviously. But yeah, I hesitate to like, all the good books have always been mentioned. Like a lot of what I read is like blog posts, white papers, like I gotta definitely like call my Substacks, because I'm just, I've subscribed to so many of them by this point. And then lastly, especially for younger folks, try to, when you're talking to some older folks, especially folks who get a lot of research from, banks and hedge funds and this and that, try to ask for primers for things. Like here's like an MBS primer. Here's a primer for Eurodollars. Here's like a primer for the high yield credit market. Here's a primer for the Brazilian economy. Even though those things, they're not always going to be perfectly up to date. If you have like a 50-page primer on something and you just really, really research it and study it, it really accelerates the learning curve. And allows you to like at least understand the vocabulary better. That's been really useful to me. I barely understood how to think about trading forward interest rate derivatives in say 2011, 2012. But now that's a lot of what I do. Is I'm looking at what do I think are the implied probabilities of this happening by this time, this sequencing, this path in the interest rate market, and then a lot of times it's just buying it 5% odds, selling it 50% odds, type of stuff, and structuring and trades along those lines. Once you have that kind of vocabulary, at least you can follow along. So yeah, that's blogs, white papers, primers. I read a lot of that stuff.
Awesome. Thank you.
Tweets.
And of course, yeah. Thank you so much for being on the podcast, Naufal. We need to do this again.
Absolutely. Yeah, let's definitely chat both. I'm happy to come on again sometime, and also happy to chat offline sometime. You seem like a really interesting guy. I would love to get to know your work.
Thank you.